Good afternoon. My name is Christopher Bent. I'm a senior legal counsel with the Investment Funds and Structured Products branch of the Ontario Securities Commission, and I'm here to speak to you today about the Modernization of Investment Fund Product Regulation Alternative Mutual Funds Amendments. So just in terms of what the outline of the presentation today, I'm going to start with a little bit of a background regarding this project and the amendments, and then I'm going to move into a summary of the amendments as laid out on this page here, focusing primarily on the amendments to NI 81-102, which is where most of the amendments took place, and then following that up with some of the other amendments that came through as part of this project, including the Prospectus Disclosure changes, financial statement disclosure, and mutual fund dealer proficiency. And then I'm going to follow that up with a brief discussion of the transition and grandfathering provisions that were included as part of the amendments. Now, at this point, I just want to take a pause and say that please feel free to submit questions throughout the presentation on the portal, because that will allow us time to review the questions and hopefully provide you with thoughtful answers at the conclusion of the presentation. So please don't wait until the end. Thanks. So just starting with some background, the final amendments were published October the 4th, 2018, and came into force January 3rd, 2019. And what these amendments did is they were the final steps of a larger investment fund modernization project. But specifically what this phase of the project did was it established the framework for a new category of mutual fund called alternative mutual fund, which is essentially a mutual fund that can invest in commodities and use strategies that regular mutual funds cannot. And this new term, alternative mutual fund, also replaced what was the prior term, commodity pool. In addition to the investment restriction changes, there were also some prospectus form requirements that I'll talk to a little bit later in the presentation, and as well as some small changes in financial disclosure that's applicable strictly to alternative mutual funds. And the other part of this project was that it finalized the consolidation of the investment restrictions for all reporting issuer investment funds within 81-102. Meaning that in addition to the rules for mutual funds and alternative mutual funds, is also included the final integration of reporting issuer non-redeemable investment funds, otherwise known as closed-end funds, within the 81-102 framework. So really it made 81-102 one-stop shopping for understanding the operational framework and requirement for reporting issuer investment funds in Canada. So jumping right into the amendments, and again, I'm really only talking about the sections of 81-102 that were amended by these amendments. So this isn't a rehash of the entire rule. So as you'll see, I'm going to skip over some sections here and there. But just to begin, starting off with the concentration restriction. Now you can see in this chart, it shows what the prior restriction was and what the amended restriction. And in this case, for concentration, the big change was for alternative mutual funds, which prior to the amendments were limited to a 10% of NAV in any one issuer at the time of purchase. That limit's been increased to 20%. Non-redeemable investment funds, referred to as NRIFs in this presentation, didn't have a concentration restriction because, again, they were largely carved out of, or they weren't fully integrated into this framework, but now they are subject to the same 20% concentration restriction as alternative mutual funds. And conventional mutual funds, which again I'm referring to as mutual funds that are not alternative mutual funds, but that's not, conventional mutual funds is not a technical term or anything. No change there, so they have to abide by the same 10% concentration restriction as they had before. And next we turn to restrictions on investing, and this is more sort of big picture in terms of types of assets and so on and so forth. So for commodity pools, alternative mutual funds, again, I'm characterizing them as the same. No change here in terms of their ability to invest in commodities directly or indirectly and so forth. Same with non-redeemable investment funds. Where things have changed here is for conventional mutual funds. Previously, they were only allowed to invest in gold up to 10% of NAV at the time of purchase. We've now expanded that to include gold, silver, platinum, and palladium, subject to a combined 10% of NAV limit. And beyond that as well, if you're a precious metals fund, which is a specific category of fund defined as a mutual fund that has an investment objective to invest primarily in precious metals, they can invest up to 100% in any one of these 4 precious metals, which we've now defined as permitted precious metals. Okay, now turning to the liquid assets restrictions, which are found in section 2.4 of 81102, and don't mind the typo on the slide, it is 2.4, there is no section 2.40 in 81102, so our mistake there. Anyway, turning to the liquid assets restrictions, again, not major changes here. Alternative mutual funds fundamentally are mutual funds, and we want to maintain them as fairly liquid vehicles. So the prior restriction of up to 10% of NAV at the time of purchase with a 15% hard cap, that's been maintained for alternative mutual funds, and again, no change for conventional funds. Non-redeemable investment funds, on the other hand, didn't have a prior restriction, but as part of this integration, are now subject to an liquid asset limit of 20% of NAV at the time of purchase with a 25% hard cap on illiquid assets. And again, the definition of liquid assets in 81102 isn't changing. So now I'm looking to the fund-to-fund investing restrictions. Again, this was more cleanup. I wouldn't say we've made any major changes here. The big one against for alternative mutual funds is that previous to the amendments, alternative or commodity pools, alternative mutual funds, were subject to the same investment restrictions as conventional funds, meaning that they could only invest in a mutual fund that was subject to 81102 and that filed the simplified prospectus AIF, which had the, I'd say, unintended effect of prohibiting a commodity pool from investing in another commodity pool. So we have fixed that. Now they can invest in any other investment fund that is a reporting issuer subject to NI 81102. So that includes other commodity pools, also other alternative mutual funds, and non-redeemable investment funds, as well as conventional funds. Non-redeemable investment funds never had this restriction, so they're under the same restriction as what you see here for alternative mutual funds. And then for conventional mutual funds, what we've done here is we've modified the pre-existing restrictions so that now they can invest up to 100% in any mutual fund other than an alternative mutual fund that is a reporting issuer subject to NI 81102. So what that includes are ETFs that other than ETFs that are index participation units, any other type of mutual fund like that. And with respect to alternative mutual funds and non-redeemable investment funds, they're allowed to invest up to 10% combined. So in other words, that there's a 10% sleeve that can be dedicated to alternative mutual funds and non-redeemable investment funds collectively. And that was really just a recognition of the fact that there can be a place for these alternative mutual funds within a conventional fund space, and that fund-to-fund investing is a very efficient way to achieve this. So now moving on to investment practices, section 2.6. Really this is about borrowing restrictions. So prior to the amendments, commodity pools, alternative mutual funds can only borrow cash up to 5% of NAV for the purpose of, on a temporary basis for the purpose of funding redemptions. Non-redeemable investment funds had no such restrictions. Conventional mutual funds had the same restrictions as commodity pools. In fact, it applied to all quote-unquote mutual funds. What has changed is that alternative mutual funds, in addition to that 5%, they're allowed to borrow up to 50% of NAV for investment purposes, subject to certain restrictions, and these restrictions are highlighted on the screen here. For example, they can only borrow from an entity that would qualify as a custodian under NI 81102. It doesn't have to be the fund's custodian, it just has to be an entity that would qualify as a custodian or sub-custodian. And in the event that the fund finds itself borrowing from an affiliate of the manager, IRC approval will be needed. Non-redeemable investment funds, subject to the same restrictions on borrowing. Conventional mutual funds, no change. And moving on now to short selling. Again, commodity pools were subject to the same short selling restrictions as conventional funds, namely up to 20% of NAV in total, no more than 5% of NAV for any one issuer. They're also subject to the cash cover requirements and the requirement that proceeds from a short sale must be paid in cash, so they can't be used to take long positions. We've changed that, and now alternative mutual funds are allowed to short sell up to 50% of NAV in total, up to 10% of NAV in any one issuer with the exception of government securities. And what that exception means is that government securities are not subject to a 10% issuer limit. You can dedicate your entire 50% short selling sleeve to Government of Canada bonds if you choose. Also, no cash cover requirements, no prohibition on using the proceeds to take long positions, and this 50% short selling NAV restriction is actually a combined limit with the cash borrowing limit, meaning that you have a 50% limit on cash borrowing, 50% limit on short selling, subject to an aggregate limit of those two activities of 50% of NAV. Now, redeemable investment funds, again, same as alternative mutual funds and conventional mutual funds. No change from what was in place before. Same restriction on short selling. And then taking a step beyond that, aggregate exposure to leverage, which again, this is the other sort of bigger change. Aggregate exposure to leverage, this is a new provision because there was no leverage limit before. So commodity pools didn't have a direct leverage limit. It was sort of they were permitted to achieve leverage through synthetically through derivatives, but of course now we're allowing direct leverage through borrowing and short selling. So all of this is going to be subject to a collective 300% of NAV, which is calculated as the sum of outstanding loans, the value of any outstanding short positions, and the value of derivatives, which is subtracting the value of any derivative positions that are used for hedging, and hedging again is a defined term in 80102, divided by the NAV, and as expressed as a percentage. That number cannot exceed 300%, and that's a hard cap. So if the fund goes over that limit, they have to take steps to get below it within a reasonable amount of time, and that is a measurement that has to be taken on a daily basis. Every day the fund calculates a NAV, it has to measure its aggregate exposure position. Non-redeemable funds are subject to the same restriction. And for conventional mutual funds, which were not permitted to use leverage either directly or indirectly before, that has not changed. Okay, so moving away from the investment restrictions for a bit, now we're going to talk about some other NI 80102 operational changes that came about. Starting with seed capital, the big change here really is that alternative mutual funds now can use the same seed capital startup rules as conventional funds. So what that means is previously commodity pools, the manager had to pay startup costs. That's not changing. But in addition to that, previously the manager had to put in a minimum of 50,000 seed capital, which had to remain in the fund at all times, like permanent seed capital. That's now changed. So alternative mutual funds will have the same seed capital requirements as conventional funds, which I'll just take you to on the next page here. So you see there, it's minimum $150,000 seed capital. The seed capital requirement is not permanent. It just has to stay in the fund until the fund has received at least $500,000 in outside investment, at which point the manager can withdraw its seed capital. But so that's the big change there. No change for non-redeemable investment funds, which didn't have seed capital requirements to begin with. And the next, I guess, big change, big area we want to focus on here is custody requirements. So again, despite all the text you see on the page here, really the big change for, and this applies to all funds, is there was a provision previously in 80102 that required an affiliate of a bank or trust company that wanted to act as a custodian. It had to be either have all of its assets guaranteed by the parent, or have assets of at least $10 million pursuant to publicly available financial audited financial statements. We heard loud and clear that for most of the bank-owned dealers and entities, it's the publicly available financial statements that was problematic. So we've removed that requirement. So now it actually makes it practical for these entities to act as fund custodians. Looking to section 6.3, we essentially made the same change for sub-custodians because there was a similar requirement regarding guarantee of obligations or having publicly available financial statements. So really the change is removing the requirement that those financial statements be publicly available. But all the other criteria still applies. And you can see here the change. The custody requirements were already the same for all three types of investment funds, so the change applied across the board. Okay, so now moving on to some of the other changes that came about as a result of the amendments. As I mentioned earlier in the presentation, there are also some changes with regards to the prospectus requirements. The big change that we made as it pertains to alt funds was that alternative mutual funds will now have essentially the same prospectus form requirements as other types of mutual funds or conventional funds. So what that means is, previous to the amendments, all commodity pools filed what we call a long form prospectus. But what's going to change now is alternative mutual funds will file either a simplified prospectus or a long form depending on how it is traded. So if it's an unlisted alternative mutual fund, so similar to your sort of open-ended conventional mutual fund, then it will file, much like conventional funds, it will file simplified prospectus, AIF, fund facts, be subject to point of sale delivery, same as a conventional fund. If it is a listed alternative mutual fund or ETF style alternative mutual fund, it will file a long form prospectus with the ETF facts, similar to what your more conventional ETFs prepare. In addition to that, there's also some alternative fund specific prospectus disclosure requirements, mainly around the use of leverage by those funds. And again, those are in the form, but essentially it comes down to having to provide specific disclosure about maximum expected aggregate exposure to leverage. And in the fund facts, for example, there's a requirement that it has to outline the strategies or the features that make it an alternative mutual fund and distinguish it from a conventional fund. But things like that. It's really just about highlighting the fact that these alternative mutual funds are different and will have and are structured differently from conventional funds in terms of strategy. So you can see here, I'm just going to go through these slides a little more quickly because the requirements are already outlined there. But no change for non-redeemable investment funds. They're going to use the same long form as they did before. However, there are now requirements similar to those for alternative mutual funds where they have to talk about the use of leverage and so on and so forth. And then, of course, for conventional mutual funds, no change because they're continuing to use the form prospectus they used before. One other thing I also want to emphasize, and really this is technically from 801-102, but it's really a prospectus form requirement. Alternative mutual funds are also using the same risk rating methodology as conventional funds. And so, as you know, this risk methodology has been in place for a few years. So as part of the amendments, alternative mutual funds are going to be using the same methodology. Of course, they're not going to have 10-year trading history, so they'll have to use benchmark indexes and such, at least for the first several years, but the methodology otherwise is going to be identical to what conventional mutual funds are using. So now we're going to go to financial statement disclosure requirements. Again, under these amendments, there's going to be some reporting regarding use of leverage. Now, this isn't new disclosure requirements, as it was. Commodity pools did have to previously provide this, although the requirement to do so was under NI 81-104 and not NI 81-106. But what we've done is we've taken that reporting requirement, we've moved it to 106, which is frankly the financial disclosure reporting rule, and now what these funds have to do is they have to describe the use of leverage, including the minimum maximum exposure to leverage, and they have to describe it and calculate it based on these new 81102 requirements. And this disclosure has to be provided in the financial statements and the management report on fund performance. And the funds are also required to disclose in their MRFP the impact of hedging on the overall leverage calculation. So what we mean by that is, as I mentioned earlier in the presentation, when calculating the 300% aggregate exposure to leverage amount, funds are allowed to subtract derivatives transactions that were entered into for hedging purposes from that number. So in the MRFP disclosure, what we're looking for is a better understanding of how much hedging the funds are engaged in and how much hedging was able to bring that number down to 300 or whatever number of the 300. So that's what we're expecting to see in the MRFP disclosure. For non-redeemable investment funds, we're imposing the same requirement, which didn't exist before, and then of course no change for conventional funds, which never had a leverage reporting requirement, and that hasn't changed on that front. Okay, now turning to the last, big area affected by the amendments, NI 81104. So as I may have mentioned earlier in the presentation, commodity pools were previously subject to NI 81104 and 102. And 104 really existed as a series of carve-outs specific to commodity pools from various restrictions in NI 81102. As part of this process, and again, this is partly about fully integrating publicly offered investment funds within 81102, we essentially took out those carve-outs from 104 and baked them right into 81102. And so a lot of the restrictions regarding commodities and so on and so forth that were previously in 104 are now just built in as exemptions from standard invest restrictions in 102. The only part of 104 that remains following these amendments are the proficiency standards. And this was kind of admittedly a bit of an anomaly within our rules, but it was a requirement that only applied to mutual fund dealers, and essentially it was additional proficiency above the standard proficiency for a mutual fund dealer in 30103 and the MFDA rules, and it applied with respect to a dealer looking to distribute commodity pools. And what it required was that the dealer have one of Canadian Securities Course, Derivatives Fundamentals Course, the CFA, or any additional proficiency that may be prescribed by the MFDA or their SRO, as the case may be. So what we've done here is we've actually maintained those proficiency standards for alternative mutual funds. So there's no change on that. And again, it only applies to mutual fund dealers. No additional proficiency requirements for non-redeemable investment funds. And again, conventional mutual funds were never subject to 81104. So there's no change there. So really what it means for the conventional fund side is that the same proficiency standards that are in 30103 continue unchanged. So that's really the sum total of the big changes coming out of the alternative mutual fund amendments. So before we get to the end of the presentation and a chance to get back to you on some of your questions, I'm just going to briefly talk about the transition and grandfathering issues. So as I mentioned at the beginning of the presentation, the amendments came into force January 3rd, 2019, and it applies to all new investment funds as of that date. So any prospectus, any alternative fund coming in the door, any commodity pool coming in the door as of that date had to abide by the new rules. It also applied to the changes that affected conventional funds, non-redeemable funds also took effect on that date. That said, non-redeemable investment funds that were in operation prior to October 4th, 2018, which was the date the amendments were published, are exempt from the new investment restrictions applicable to non-redeemable investment funds in Part 2 that I talked about earlier. However, this exemption only applies to non-redeemable investment funds that were in existence prior to October 4th and do not subsequently file a preliminary prospectus. So essentially, any non-redeemable investment fund, including a pre-existing one that files a preliminary prospectus after October 4th, must comply with those amendments upon the coming of the fourth date. And really that's about truly grandfathering those long-term, long-time non-redeemable investment funds that have just been operating for years unaware, but if they try to come back to market, they must do so in compliance with the new rules. And then finally, for existing commodity pools, any commodity pools that were in existence prior to January 3rd are being granted an additional 6 months to adapt to the amendments. And that includes making any changes to their investment restrictions if necessary, as well as ensuring that they distribute pursuant to the new prospectus form requirements as of July the 4th. So like I said, that's the alternative mutual fund amendments in a nutshell. So, and that's the end of the presentation. So if you have any questions, please let me know.